Welcome to Yahoo Finance Live. I'm Shauna Smith along with Jared Blickery, who's in for Dave Briggs. Let's get you up to speed on everything you need to know as the clock strikes 3 p.m. Eastern Time. Well, stocks are rebounding this afternoon following the worst week of the year. Pending home sales blowing past expectations, jumping 8.1% in January for its biggest month-over-month increase since June 2020. But is this momentum going to last? We will break down the numbers for you.
And is Warner Brothers Discovery taking a page out of Disney's playbook? One analyst couldn't help but notice some similarities. And Needham & Company media and internet analyst Laura Martin tells us what she sees ahead for the two media giants.
But let's begin with the check-in on the markets, because once again, we are looking at gains here across the board, rebounding from the worst week that we have seen for the market since the start of the year. The Dow up 87 points here. S&P up just about 0.4%. The Nasdaq leading the way, up about 0.7%. On a sector basis, consumer discretionary industrials leading the way. Utilities, though, the laggard in today's session.
All right, and let's get you up to speed on the AI arms race. Snap shares moving. Well, they were moving higher, and they're still moving higher, but by just a little bit, about 73 basis points. That's after announcing today that they are entering the chat wars with a new OpenAI-powered bot for its Snapchat Plus subscribers. Joining us now with more on the AI hype is Brent Thill. He is a Jefferies senior analyst. Brent, always great to see you here. I want to direct everybody's attention to the Wi-Fi Interactive, which is an excerpt from the company's prospectus when they went public all these years ago. And it does say Snap is a camera company. That was a fad that they happened to jump on that bandwagon at the time. Not a lot came of that. Just wondering how deeply and how seriously are they taking the AI bandwagon this time?
Yeah, I think, look, every tech company is taking it serious, and it's being woven into the fabric of every major technology company we cover. So when you log on to Snap, you're going to be able to engage with the chatbot versus just seeing, static news. When you log into your Microsoft PowerPoint, if you need a presentation built, it'll ask you, how can I help you? What can I do? To Google, to every major tech company, Amazon, Apple. So, look, it's not a surprise. I don't think this changes the tone for them specifically, but I think ultimately everyone is trying to follow Microsoft's PR win, which they won the PR battle out of the gate with their announcements, and now everyone's playing catch up. So we expect the AI hype to continue. We do believe some of it's hype today, and we think ultimately it is real, though. It's not total hype, but it's going to take time for this to produce revenue and profits for a lot of these tech companies. But make no mistake, everyone in tech is chasing it, and if they don't have an AI strategy, they're going to be left on the side of the highway and get passed quickly. Again, I look at this and I think a lot of this is initial hype, and the real meat of these announcements is still yet to come in many quarters, if not years out from now.
Brent, you mentioned the hype here a couple of times. Do you think this excitement, though, around AI, is that justified up until this point? And you mentioned the fact that Microsoft now has this clear lead with the investment in OpenAI with ChatGPT. What about its competitors, Google, the ability there to catch up to Microsoft?
Yeah, I look at the other way around. I really think that Microsoft is so far behind. Look at the market share of Google versus Microsoft. And so when I say, I think Microsoft won the PR battle, again, they have to prove the longevity of Bing. We ran a survey of 1,000 consumers, and 4% said it was the default search. That means 96% were using Google. So I wouldn't call that catching up. I'd say that Microsoft's way behind. But ultimately, that 4% is going into the low teens. And so, again, this still has a long way to go. I do not believe Google is going to be left on the side of the highway on the AI race. We think that ultimately they have a great position. Remember, AI can't work unless you have a lot of users and a lot of content. And they have more users and content than Microsoft. And so if you think about ultimately their ability to play catch up in the PR side of this, I think they can do it. And I think from a technology perspective, they will do it. Right now, Wall Street is not giving Google credit. Everyone is saying Microsoft wins, Google loses. It's that simple. I think that's ridiculous. We've seen this in past hype waves when Steve Jobs is alive saying Adobe Flash is dead. Everyone thought Adobe was dead, and Adobe went from $30 to $700 in terms of the stock. So I like Google here. I think it's a great buy. I think the death to Google is greatly exaggerated by all this AI hype. And again, remember, there are like many companies other than Microsoft that are using OpenAI to embed in the fabric of their own applications. So you have to say, well, is this Microsoft's technology or is it a partner's technology? And last time I checked, Google is building a lot of this organically. So I'm a huge fan of Google here. I think the reaction's been greatly over-exaggerated where they're going to end up.
So then, Brett, maybe the better way to ask that question would have been, how much will this help Microsoft then down the line? Because I was going through the results of your survey, and it was pretty fascinating. I know it was a small number of people who use Bing, but those who had tried the new Bing told you that they would make it their default search engine. Those who tried the new Bing, 86% said that they were very impressed. How much then do you see this potentially helping Microsoft on the search engine front?
No doubt this helps Microsoft, right? They have no share. So it puts them on the map on terms of the share. So you have to look at it from Microsoft two angles, consumer and enterprise. On the consumer side, they badly need a kickstart. This will help them. Again, remember, many of the consumer products that Microsoft has launched have been duds. The Zune in music, their advertising business. They've written off many past acquisitions. What happened to Nokia on the handset side? Are they in the mobile phone war? They try, but they have not really had great success. On the enterprise side, I'm very bullish. And again, I was a Microsoft developer. That's how I got into this business. I am a huge fan of what they can do in enterprise AI, which is company launches earnings like Workday tonight. We use the AI engine on Azure to basically take the key numbers out, compare and analyze, and we can do it quicker, faster, and make good decisions. I'm really bullish about that. That's still a long ways off. But so I think ultimately you have to basically separate and say, not all AI is created equal. Microsoft's going to have, no doubt, a win on the consumer side because they have no share. But I think the bigger win's going to come in the next several quarters, if not years, on the enterprise side, where I'm more bullish. That's their fastball. That's what they're known for. And we are testing their products internally, and we are really excited about what it could do for us in our own jobs. And so, again, I separate it, and I think it's kind of a tale of two cities, if you will. I'm not negative on Microsoft. I think the consumer side will do well, again, just because they haven't really been, on the map. But again, I think you have to go back to, do you need a 5-day Tokyo trip planned by Bing? And I think the answer is no, I don't. Do I need basic weather? Do I need basic things? Google is giving that to you today.
Well, 5-day trip plan, it doesn't sound bad. It would save people a heck of a lot of time. But Brent, I definitely get what you were saying. Brent Thill, always great to have you. Look forward to having you back on the show again soon. All right, Warren Buffett publishing his annual letter to Berkshire Hathaway shareholders this weekend. In his latest entry into the 60-plus year tradition, the so-called Oracle of Omaha preaching the merits of reinvestment, writing, quote, "The power of compounding your money inside a successful business for a long time is nearly unmatched in capitalism." Joining us now to discuss a little bit more about that and also what else we heard from Buffett over the weekend, we want to bring in Bill Smead, Smead Capital Management Chief Investment Officer. Bill, it's great to see you again. So certainly no shortage of lines that we could pick out here from the shareholder letter over the weekend. Share buybacks, taxes, earnings, long-term optimism here on the U.S. economy, just to name a few. Just first, your takeaway from the shareholder letter that we just got.
Well, we thought it was a great letter. And one of the things was he said, he makes an incredibly important decision on average once every 5 years. In a 60-year stretch, he came up with about 12 investments that made all the difference for him, which you compare that to what most people do and what most of your watchers and most the behavior of investors in the United States, and they change their their stocks about as often as they change their clothes.
Bill, great to see you here today. And you and I have talked about this at webinars generally surrounding Warren Buffett's releases of the annual shareholder letter in years past. And if we're on this schedule, let's see, a dozen good business ideas once every 60 years, or every 60 years, that's about one great idea once every 5 years. Do they still have it? Munger and Buffett, are they still executing?
Yeah, the reason for that is they got very large, and that limited what they could do, right? They have to do things in a very, very large way. When in the first 25 years, Buffett was picking stocks, he had a huge information advantage over everyone else, and the education he got from Ben Graham, who was an excellent buyer of 50-cent dollars. So what Munger helped him realize in See's Candy and brands is that as you manage very, very large amounts of capital, you're going to be limited in the number of good ideas that are available to you. If Buffett was running $10 billion, he could have just gone out in the spring of 2020 and had a Ben Graham delight session. But instead, he had $120 billion and has looked for things like Oxy and Chevron to put it in based on their view of the next 10 years.
And Bill, you and I have also talked about some of the secular tailwinds benefiting certain industries. You take a look at millennials, and with the continued demand we expect them to have for housing over the next decade, you can tie oil into some secular themes. They're just wondering how you're seeing Buffett play out in the 2020s and his style of investing here.
That's a great question. Buffett mentioned that you need to be a lifelong learner, and when things change, you need to learn and adapt with it. And what he figured out was the railroad industry was going to be dramatically more attractive to him when it was only 4 companies, including the company that he bought, Burlington Northern Santa Fe. We feel that same way about the 3 home builders that we own. That industry has changed dramatically. It used to be a land development business where you put a house on it to turn the lots over, right, to gain the profit out of the lot. Now, in the case of Horton, Lennar, and NVR, the vast majority of the land they build on is developed by someone else, and they're just a home manufacturer. So we find that business incredibly attractive because there's 92 million millennials coming, and now that people have gotten off of their big city, single, expensive apartment routine in the major coastal cities and are spreading themselves out across the country, there's an awful lot of homes to be built.
All right, we got to leave it there, but always glad to have your insights, especially when it surrounds the Warren Buffett annual shareholder letter. Bill Smead, thank you. Now, let us get you up to speed on January's pending home sales. The index increasing for the second consecutive month, up 8.1% from December, the largest jump since June of 2020, just about 3 years ago. Despite this bump, pending home transactions are down by 24.1% year over year, with the National Association of Realtors chief economist, joining us, Lawrence Young, saying an annual gain in annual home sales will not occur until 2024.
Yeah, certainly. Lots of questions just about where, Jared, this real estate industry stands right now, because yes, that month over month increase, it was the best that we had seen since 2020. Yet that year over year decline, off over 20% on a year over year basis, certainly just highlights that this industry is very weak up against a challenging macroeconomic backdrop. Mortgage rates, they had shown some improvement during the month of January, but they have also begun to tick higher. So not much hope that some of that momentum that we have seen from the last 2 months, that of course is going to carry through here over the coming months, given the fact that mortgage applications to buy a home, they fell for much of February. Pending home sales off 24% year over year basis. So certainly a challenging picture here for housing. Now, JP Morgan, though, despite the confusing macroeconomic backdrop right now, they initiated their positions on Zillow and also on Redfin. Out with a new note today, they're overweight Zillow. They have a neutral rating on Redfin. Expect recovery to begin in the latter half of this year in 2023. So the bull case here from JP Morgan on Zillow, the fact that it can navigate some of those near-term headwinds because it is the most visited online real estate platform. They do have solid margins. They do have that active share repurchase program. That, of course, giving Zillow the edge. On Redfin, though, the other hand, the brokerage model making navigating some of these near-term headwinds more challenging. So they at least see the risk-reward balanced here at current levels, also given the macroeconomic backdrop right now. So higher mortgage rates could be a little bit troubling for this industry, at least over the next several months.
Yeah, now I'll show you a picture's worth 1,000 words here on the Wi-Fi Interactive. I have Zillow Group up over, it looks like this is a max chart. So you can see most of the activity here took place between the prices of about $20 and $30 and $60, except for the pandemic when we had that huge boom right there, but things have normalized. So steadying, I would say they settled back into that very old trading range right here. Yeah,
they certainly have. Again, Zillow right below $42 a share. All right, well, we are just getting started here on Yahoo Finance Live. Coming up, Goldman Sachs CEO David Solomon is in the hot seat ahead of the bank's Investor Day tomorrow. We will break down what to expect from the big event. Then Fubo TV shares a slumping following the streaming service's fourth quarter results. You're looking at a loss of just about 14%. We will get an analyst take. And another busy earnings week, earnings day, Zoom, Occidental, Workday, all reporting after the bell. We will bring you those numbers as soon as they're released. Don't go anywhere.
Welcome back. Goldman Sachs CEO David Solomon is going to have to answer to investors Tuesday as he presents financial plans for the company's future. Yahoo Finance's Ali Cannell joins us now for the Investor Day preview. Ali, what can we expect here?
Hi, Jared. Well, Goldman has faced a pretty rough 2022, profit slumping by half. So this Investor Day tomorrow, it's going to be very important in setting the tone for 2023. I do expect to hear more details about the asset and wealth management business, otherwise known as AWM. That division has about $2.5 trillion in assets and has been branded as key to unlocking value, especially after Goldman's failed attempt at consumer banking. Marcus by Goldman Sachs losing nearly $6 billion since its inception. The Wall Street Journal reporting that the Federal Reserve has now launched an investigation into Marcus and whether it had the appropriate safeguards in place as it continued to grow. So overall, this has just been a huge disappointment, especially for investors. CEO David Solomon, he has been heavily criticized about how he handled that unit. So looking ahead to tomorrow, investors are going to want a very detailed plan. Where does Goldman go from here? Is there a path to a better multiple? Execution is going to be key, and that's the narrative that I'll be closely watching. And if we take a look at shares heading into tomorrow's Investor Day, they are relatively flat. They were up earlier on the heels of Friday's news that the bank has approved $30 billion in stock buybacks with no set expiration date. And this is something that we've seen more and more from S&P 500 companies. Historically, stock buybacks, they tend to raise the share price, and that's always a good thing for investors. So a lot to discuss tomorrow.
Certainly will be a lot to discuss. Ali, when it comes to David Solomon, we know he has been criticized multiple times over the last several quarters, and you almost feel like that pressure is beginning to mount even more with the cost-cutting efforts, with the consumer business struggling, with their investment banking business also not doing too hot. Where do you think he's feeling the most pressure right now?
I think the Marcus fiasco is number one. Also, the fact that Goldman is now trailing rivals Morgan Stanley and JP Morgan when it comes to that price to book ratio. But even outside of the banking business, Goldman Sachs CEO David Solomon is a DJ. That's outside of his day job. There was a New York Times article out saying that there's potential conflict of interest there, especially as the company has really been in turmoil. You mentioned those cost cuts. 3,200 employees were let go. There's an expectation that there will be more cuts on the way, given the uncertain revenue environment right now. So his leadership has really been called into question, whether or not he's really dedicating his full attention to this business. So tomorrow, all eyes are going to be on David Solomon, his overall tone, his sentiment, and ultimately his message and plan for how he wants to get the company back on track.
It's a hobby, you know?
Yeah, that's what I'm saying.
I
gotta do something outside.
Elon Musk gets Twitter and SpaceX. He can't even DJ on the side. Come
on,
guys.
The justice.
I know. We're gonna find out tomorrow.
Yeah, maybe he'll do a little DJ soul at the Investor Day.
That would be very fun.
All right, Yahoo Finance's Ali Canal. Thank you for that. Coming up, shares of Warner Brothers Discovery. They are popping today as one analyst says the company's strategic plan is mirroring another familiar media giant. We're going to speak with Needham's Laura Martin on the other side of this break.
Fubo TV, it's a top trending ticker on Yahoo Finance today, and you can see why. Shares off just about 14% after the company's fourth quarter results. New subscribers, a narrower than expected loss, initially helping the stock, but shares certainly did reverse after Fubo disclosed that it did sell shares at, quote, negotiated discounts. For more on this, also where we stand in the streaming space at large, we want to bring in Laura Martin Needham, a senior media and internet analyst. Laura, it's great to see you again. So let's start with what we heard this morning from Fubo TV. Lots of questions about the direction of this company. What would be the best case scenario moving forward? What do you think?
So I thought, let's make a distinction between fundamentals and the money they raised this morning. So shares were up like 5% before they announced that they'd done a big block trade at a discount to Friday's close. So I really think the softness today, which started at down 19% as soon as they announced that they'd raised $70 million, round numbers, is now down, I don't know, 10 to 13%. But the fundamentals here are really very impressive. 39% revenue growth, 39% subscriber growth, 30% advertising revenue growth. They hit 1.8 million subs, adding 270,000 subs, which was twice our estimate, which means they're acceleratingly adding subscribers at a time where Disney and Netflix are slowing their subscriber adds and guiding us to lower long-term subscribers. So sort of bucking the trend fundamentally. They still lose money, which Wall Street has a big problem with. And they needed to raise the money today, which sort of puts a cap on how much appreciation I think Wall Street's worried. They worry that every time this company has good earnings, they're going to sell shares, which then puts a cap on the appreciation potential for Wall Street investors.
Yeah, two sides of that coin right there. But I want to move on to something related here. Florida Governor Ron DeSantis, he just signed a bill into law this morning, giving him greater control over Disney's special taxing. It's called the Reading Creek Improvement District. Now, what implications does this have for the parks business and the company's bottom line?
Okay, so two things. Philosophically, I think DeSantis is making a run at the presidency, and I think a lot of people who don't really understand the issue very well, a lot of Republicans, he's doing this because Disney is too woke. And Disney has 75,000 employees in Florida, and it is the largest employer. And by the way, in a content company, you actually can't find employees unless you are woke. So you just don't have a business unless you have woke employees that create content and are in the parks doing service. So I'm not sure Disney has a choice. I also think it's on the right side of history, is my opinion. But DeSantis is running for president. In 2 years, my opinion is he'll be gone because I think it's, he just will be out of this seat. And then we'll see. The problem with him taking away these, which he didn't really do, actually. But, there's $1 billion of debt on that's Disney's. And they pick up $1 billion a year costs and for the roads and all this stuff. All that would transfer to the communities locally that house the Walt Disney if he actually took away their benefits. So he's doing it in name, but there's a lot of liabilities that would get put onto the Florida state budget if he actually did it. So he's basically taking a victory lap for actually not very much substantively.
So Laura, you don't see this at all complicating how Disney runs its parks, at least in the near term?
I do not. I do not. I mean, in theory, it makes them get more approvals from local governments to build the next hotel, but their next hotel brings employment. So what local government in Florida says, no, we don't want you to build it that way. We want you to build it this way. So no, I don't think so. I actually think nothing happens to Disney. And by the way, we have a much kinder, gentler CEO here who I do not think this would have happened if the CEO had had a different guy in the seat when this legislation that's the big fight over it was happening.
Well, keeping the Disney theme here, you said in a recent note, CEO David Zaslav for Warner Brothers is repositioning the company to be a storytelling company. This has some parallels to Disney. Just wondering where you can go from there.
Okay. So Warner Brothers Media has nothing to do with theme parks. So we're leaving companies. What it is saying is what I think Disney has demonstrated very successfully over the last decade, which is what Warner Brothers Discovery is now saying is we want to have film franchises and we want to expand them into consumer products and into video games and into merchandise and into global streaming. And we want to bundle all that together and have all revenue streams from theatrical to streaming to linear TV. That's all super smart. And we want to focus on our franchises like DC Comics and Harry Potter. They have some world-class franchises. Superman, they haven't had a Superman movie in 10 years. So this is a long-term standing Disney under Iger, a long-time where they only give money to their franchises. And because when you build a new Superman film, you basically generate traffic and viewing of your old Superman library. So this is a smart play. So they're following the Disney roadmap strategically. Now we have to see if they can implement it.
Yeah, Laura, what are you going to be focused on first? Because I think there's lots of questions about implementing the plan going forward, what this mess currently looks like inside the walls of WBD, at least today. What's your assessment just in terms of the changes that we have seen and kind of how they've done 180 on a couple of those initial changes?
So I think, listen, let's go through. So on the cost side, we really have an outstanding chief financial officer here who has a track record of whatever he tells you he's going to cut costs. He's really going to cut costs 2 or 3 times more, which means we're going to see margin expansion. So I'm very highly confident, like 80% confident that the costs will over deliver estimates. So we'll get margin expansion. On the revenue side, I'm also highly confident that David Zaslav, the current CEO of Warner Brothers Discovery, who has been running Disney, has been running Discovery assets. He's going to continue to do a great job there. The big question mark is the big allocation of capital this year, which is rebuilding up that film slate. Can DC Films do a better job of closing the gap with Marvel? Revenue, fandom. You know, the reason the Disney engine works is they have like Star Wars, they have the princesses, they have massive fan bases in these properties. Warner Brothers never been able to do that. So let's see if under David Zaslav and his management team, whether the film business can actually create these huge properties that Disney has, and it takes 3 years. So he will spend a ton of free cash flow this year of the empire of Warner Brothers Discovery, and you won't get $1 of revenue till the film comes out 3 years from now. So you won't know how well they're executing for 3 years, but you will have invested round numbers $10 billion in films. So that's risky.
Yeah, Laura, so then that points to the fact that what do you make of the current valuation today with share price, right below $16 a share? Certainly has been off to a strong start for the year, coming off what was a very rough 2022. That jump that we've seen, do you think it's fairly valued where it's trading today?
So we have a hold because we don't like being in front of this usage of free cash flow. So you're going to see income statement margin expansion, but we think they're going to be eating free cash flow in the background as we rebuild this film slate. So we'd rather stay on the sidelines in the near term, and watch how they execute, the integration, let's say.
Laura Martin, always great to have you. Thanks so much for joining us this afternoon. Have a good week.
Thank you.
All right, coming up, a great day for donut lovers. McDonald's announcing it is expanding its Krispy Kreme partnership. We've got the details for you when we come back. It's time for a triple play. 3 stocks that we're watching in the final 30 minutes of trading. We've got Krispy Kreme and McDonald's, Manchester United, and Altria Group. So quite a full picture here, covering multiple industries. There we go. Let's kick it off with Krispy Kreme and McDonald's, giving their fans what they crave. Starting next month, McDonald's will be selling the donuts in 160 locations. It's just throughout Kentucky and Louisville and Lexington and those surrounding areas. So here's what's going to be offered. The original glazed donut, one of my favorites, the chocolate iced with sprinkles donut, and also the chocolate iced cream filled donut. Now, the burger chain is doing it to get a better read on customer demand and also how a larger scale potentially launch impacts restaurant operations. McDonald's business has been holding up well with more people visiting its locations in the second half of the year. We know consumers are getting very cost conscious, many trading down. McDonald's has been benefiting at least from now, or at least up until this point, from that. Krispy Kreme, I'm a big fan of this. It's only in Kentucky, which I'm a little bummed about, but an afternoon stop by McDonald's getting a donut, I like it.
I think it's the pairing too, right? Shauna, what do you have with a donut? You have a coffee, right? And McDonald's execs just a couple weeks ago in the earnings call, when asked about, what's the big growth driver for you this year? Where do you think you can grow more? They said chicken and coffee. Well, if you're going to get that afternoon coffee, a donut does actually make sense. It pairs well with the coffee. I think that's sort of what they're going for here, Jared.
Yeah, I'm not going to disagree here. I was just looking at Krispy Kreme stock here. Has been around for a while. I believe it came to market over the pandemic. Interesting chart here. Looks like we got the lowest low only recently, but like many other companies, up strongly off of those lows this year.
Well, Jared, for having a donut, we're having a coffee. We might as well watch some soccer, right? Let's take a look at some Man U shares. They're in the red today as a report from the Financial Times indicates the team might not be worth the $6 to $7 billion price tag some have reported the Glazer family is seeking. The Financial Times points to recent data from Deloitte tracking revenues across professional soccer. The key data point you can see here on your screen is that while Manchester United long had been a revenue leader, its advertising revenue in the last 5 years is now below the average of the other top 6 clubs. You can see Man U spiking there in 2015, now coming back down. Basically, what you're looking at is Manchester United was once sort of in a league of its own in some ways in European soccer, and European soccer has grown a lot over the last couple of years, and so have some of the other top clubs. So it's not like
including the other Manchester.
Right, exactly. The other Manchester City has grown a lot. And so you don't necessarily just pay for the Man U brand maybe as much as we initially thought.
Yeah, makes sense to me. I was just looking at a longer-term chart. This goes back 10 years for Manchester United on the Wi-Fi Interactive. Huge spike you were talking about there. This almost looks like a biotech stock with those binary options of whether or not it's going to clear the FDA. But is this going to clear the bidding? I guess the bidding process. I think
right. It's driven shares a ton over the last couple months.
I guess not surprising to see the chart behave like that. All right, I am teeing up Altria, trading to the downside. That's as a cigarette maker is in talks to buy Enjoy Holdings for at least $2.75 billion. By the way, this is a company that, much like Juul, is also selling vape products. Now, with a deal possibly being announced as early as this week, there's room for an additional $500 million if certain regulatory thresholds are met, and it's on the regulatory side that investors might recall Altria's lockup with Juul Labs, where they paid $12.8 billion for a 35% stake in 2018. FTC has taken the position that that acquisition violated antitrust law. That company, I believe, ended up in bankruptcy court. So a divestiture decision still being expected in a few months. That Juul investment, it is now $714 million being written down from $38 billion. So what's different this time? Well, this is a company that they're acquiring that already has a right, one of the few that has the legal rights to sell these vaping units in the U.S. So that's starting off on the right foot, but I don't think they're going to get the incredible traction that they got from Juul back in the day because guess what? These things are bad from you. We knew that then, but now we really know it again.
Yeah, exactly. And less people are using them. At least that seems like that's what studies have shown as of late. But we know Altria has wanted to get into this space now for quite some time. Clearly, their investment into Juul did not work out the way that it hoped when they initially made that investment back in 2018. So maybe this will work out for the company going forward. But you mentioned that regulatory question there and exactly what that would mean. We'll be up against some regulatory questions, you would think, at least in the short term because of that stake in Juul.
It seems like the regulatory part is just the key here, right? Yeah. I mean, you look at a company that was valued at over $30 billion down now to under $1 billion simply because of that regulatory piece. Certainly something to watch.
Certainly is. All right, well, coming up next, stocks getting a bid today, all trading higher as Wall Street is looking to rebound from its worst week of the year. We've got more on that when we come back.
Welcome back. Inflation is dominating headlines. The Fed's fight to cool prices is not going according to plan. Fed's favorite inflation measure rose 0.6% in January. That is more than what was expected. And consumer spending kicked up to 1.8% last month. This is the biggest increase since March of 2021. Our next guest is adjusting his call on where rates are heading. Joe Brusuelis, he is the RSM chief economist, is with us now. Joe, great to see you here. I think the last time I saw you was back in our studio on payrolls day. Big day last month, but things have changed. So what are you looking at today?
Well, what we're looking at is not too much of a different thing than what we saw that day. If you remember, we were on the desk and I said, look, these numbers are going to get revised down, but even if they're cut in half, they're still too strong. Hiring is just occurring at a torrid pace. Spending is too strong. And at a certain point, you do have to admit that inflation, especially in the service sector, is proving stubborn and sticky. And I think that it's going to be a bumpy ride down to a more tolerable rate of inflation. Notice I'm not saying 2%. Right now, the underlying inflation rate in the economy is somewhere between 4 and 5. So the Federal Reserve has a lot of heavy lifting in front of it before it can even think about relaxing on inflation.
Well, Joe, I guess what do you think is going to be maybe a more acceptable target here for the Fed down the road if we're not waiting for it to drop to 2%? And you mentioned the fact that the services sector inflation, that the inflation in that sector remains very sticky. Have we seen a peak in services sector yet in terms of prices?
No, I don't think we've seen the peak yet, and that's one of the problems, which is why we're going to get the 325 basis point hikes at a minimum through the middle of the year, taking us to that 5.5 to 5.75 range. I think that what's really key is that we're going through a structural adjustment. This isn't cyclical, this is structural, and this has to do with long-simmering geopolitical tensions, economic tensions, and then the lingering impact of the disruption of supply chains, which are all going to cause inflation to remain well above what we've experienced over the past 20 years. Just let me put this straight out there. The Fed's 2% target is likely not to survive this business cycle. I think that we're likely going to see a 3% target. They'll never tell us ex ante, it'll always be ex post, but it'll be operational before the public is actually informed on this. Here's why. It simply will cause too much of an increase in unemployment to get the target back down to 2%. And I just don't think there's an appetite for that. Moreover, with labor being tight, wages are going to remain elevated compared to what we saw between 2000 and 2020. So you add all that up, things have changed significantly over the medium to long term.
Yeah, I just wanted to just stop you just right there. And we're talking about this 2% inflation mandate that the Federal Reserve has had officially and unofficially going back about 20 years. And now the Federal Reserve, Jay Powell in his press conferences has said, well, we're not going to abandon the 2% inflation target. What you're saying, I believe, is that they will surreptitiously kind of abandon it in principle and then just tell us later, maybe after some case studies or something, what have you. Exactly what are you laying out here? Because this is something that I see debated on Twitter quite a bit, and just calling for the wholesale abandonment of a 2% target in favor of a 3% one is a big regime change.
Well, essentially what will occur is that inflation will largely stabilize probably somewhere between 3 and 3.5%. And the Fed will just have to admit the structure of the global economy's changed. The G7's decoupling from China. The tensions both in the economic and security realm between China and the rest, not to mention the war in Afghanistan, and the demographic changes that are occurring in the United States all demand a different inflation target. That 2% inflation target was appropriate for the pre-pandemic era, and what I'm saying is that we're now moving into a period where we just have to call it for what it is. That 2% target is no longer appropriate given the structural changes that are occurring. The Fed's going to have to reset the target. They're just not going to tell us in advance of actually operationally doing so. Remember, the 2% target was made operational roughly around 1986 under Alan Greenspan, and it wasn't formally made until Ben Bernanke was in charge at the Fed.
Well, Joe, one area of the economy where we certainly have seen some weakness has been the housing sector. And I think there's a lot of conflicting reports, or really conflicting outlooks, I should say, in terms of whether or not we have seen the worst of it, what the housing market is going to look like from here on out. What are you predicting?
So my forecast for 2023 was that we'd see about a 10% decline in prices. And we've seen that in some areas. I think when we talk about housing, it's best that we don't talk about it nationally. We need to talk about it in terms of the regions, the metropolitan statistical areas, the big metro areas. My sense is that with rates continuing to rise, you'll see mortgage rates go back up. So I'm not ready to call the bottom in ways many are. Now, that being said, as we move forward throughout the year, you will see those prices come down in some areas, and that will make the 6 to 7% mortgage rates more palatable. And I see many developers actually offering buy downs to get the operational rate down into the mid 4s. Now, if you've got the cash to do that, that's something you want to do. And indeed, you probably is a good time to buy, right? Mm-hmm. I think one of the things that we need to begin to think about is that those of us who got into house, who built a house, who refinanced a house during the pandemic, saw, 2 and 3% mortgage rates. Now, that's not going to come back. So we really need to have a more concerted national conversation around we need to build a lot more homes, and we need to do so fairly quickly. Right now, given the polarization in Washington, that's not going to happen, but that's a conversation that absolutely has to happen and must happen.
All right, we got to leave it there, but some really interesting theories. RSM Chief Economist Joe Bruce-Wallace, thank you. Coming up, President Biden's student loan forgiveness program is heading to the U.S. Supreme Court on Tuesday. We're going to tell you what you need to know up next.
Warren Buffett's annual Berkshire Hathaway shareholder letter is set to be released on Saturday. Now, the letter digs into Buffett's top holdings, how his investment strategy has played out over the last year, and what could come next for the firm. Yahoo Finance's Josh Schaefer is here with a breakdown of those top holdings. Josh, on over to you.
So like most investors, Warren Buffett's diversified portfolio has consolidated over time. As of December 31st, 2022, Berkshire Hathaway's top 5 holdings made up about 75% of the company's entire portfolio value. Apple is Berkshire's top holding, accounting for about 40% of the company's portfolio. That's about 4 times the size of the next closest company, Bank of America, which accounts for just more than 11% of Berkshire's holdings. Up next is Chevron. The oil giant accounts for just shy of 10% of Berkshire's holdings, while Coca-Cola, one of Buffett's most famous investments, particularly given his insistence on always sipping that soft drink, represents 8.5% of the portfolio. And American Express, a longtime holding of Buffett, rounds out the top 5, accounting for 7.5% of Berkshire's holdings in this.
The Supreme Court is taking on President Biden's student debt relief program this week. Now, there are two cases on the docket that could affect some 40 million borrowers across the country. Yahoo Finance's Alexis Keenan is here to break it down. Alexis, what are the details here?
Okay, so the Supreme Court, this happens tomorrow, oral arguments, and it's going to be the Biden administration, the Education Department, against borrowers. There are two borrowers who say that they should have been given an opportunity to comment on this rule, this plan that was laid out by President Biden. And the plan says that, and it's suspended right now while these cases play out, the plan says that certain taxpayers, if they make less than $125,000 a year, could be eligible for up to $10,000 to $20,000 a year in forgiveness on their student loan debt. The first case brought by those two borrowers, they say they should have been able to comment. The other case is brought by 6 attorneys general for Republican states, and they say that their tax revenues would suffer, or possibly their investments in student loan products would suffer if this program is rolled out, because fewer loans, fewer payments, right? Fewer interest payments. So the court is going to consider first and foremost, and that's standing. Can these parties even bring these lawsuits in this court? That's a critical concept. It's a doctrine that they have to show that they would be injured. They'd suffer some kind of particular harm should this plan roll out. So that's the first thing the court's going to look at. If they say, yes, one of these parties has standing, the next thing they're going to look at is whether the merits of the case. They're going to say, would there actually be harm to these states? And should these borrowers have been able to comment? So the fight, though, it's over some very particular text, and it's a 2003 law called the HEROES Act. And what it says is that the education secretary can waive student loan payments for those impacted by, and quote, a war, that's one instance, or other military operation or a national emergency. National emergency in this case, according to the Biden administration, that's COVID-19. That's where he says the relief is justified here. But take a look real quickly. Estimated cost to taxpayers, U.S. taxpayers. According to the CBO, they say that this would cost $400 billion in present day value. Also, that would be on U.S. student loan debt as of December last year of $1.76 billion. And as you mentioned at the top, there are 43 million borrowers at stake here, most of them holding these federal loans.
Yes, 43 million. We're talking about 400 or hundreds of billions. Some small details to be ironed out this week. Thank you for those details, Alexis Keenan. Coming up, we are counting down to the closing bell on Wall Street. Stick with us on Yahoo Finance Live. Welcome back. We are just a few minutes away from the closing bell on Wall Street. Let's take a look at what's happening in the majors. As you can see, a lot of green there, but not a whole lot in terms of each one. Dow's up 20 basis points, S&P 500 up 1/4 point, Nasdaq up about 2/3%, Russell 2000 somewhere in the middle there, up about 39 basis points. Here is the sector action. Consumer discretionary, XLY, that is the only sector of the S&P 500 ones, and there are 11. That is over 1% right now. That is followed by industrials, tech, and materials. All of those outperforming the S&P 500. To the downside, we have utilities, healthcare, and staples. All of those defensive sectors, those are in the red. So a little bit of a bullish scenario unfolding here to begin the week. Taking a look at some of our leaders and sentiment indicators. Solar energy, that's TAN, that's in the upper left, that's up more than 2%. So is our gambling ETF, that's BETS. Meme on its heels, KWEB, that's a Chinese internet ETF, that's up more than 1.5%, and the transports right there following along with them. Let's take a look at some of the meme stocks. We saw some action a couple weeks ago, then we saw a lot of that fade off and roll off. A lot of the fringier parts of the market were selling off hard last week, and now a little bit of money moving back in today. AMC, that is up about 22%. Carvana up 12%, not a whole lot of outliers other than those that I'm seeing. And here's our banking sector. Now, taking a look at the majors here in the U.S., kind of a mixed board. Morgan Stanley down almost 1%, while JP Morgan up almost 1%. But let's take a look at energy. This has been one of the volatile sectors, not only of this year, but the last one. BP up 1%, ExxonMobil down about 1/3%, and Chevron just up barely. Now, let's take a look at some of the EV sector news that we have for today. Tesla's up 5%, Rivian up 6%, and looks like Checkpoint up 4%. So we are seeing some movement in here. And if we check out what's happening in the, I would call this the China space. I was also looking for the ARK Invest space. We'll get to that in a second. In terms of China, we are seeing Pinduoduo. That's those shares up almost 3%. Baidu up 5%. And here's where I was going a minute before. The ARK Invest, that innovation, the disruption theme. DraftKings up 3.5%. Looks like NTLA up 4%, but seeing some red in some other areas. So all in all, kind of a mixed day here. Difficult to point to any huge underlying patterns. But as we take a look at the Dow here, just want to draw attention to some of the industrial stocks. We got Caterpillar up 1.5% and Boeing up 1%. And let's just take a 3-year view of Boeing as we head into that closing bell. There we go. Still down about 30% over that time frame.
All right, well, that wraps up today's trading day. Starting the week off on an upbeat note, we can say that, with the Dow closing up 72 points, S&P adding about 0.3%, the Nasdaq, the leader of the three major averages, up just about 0.6%. Well, let's take a look at some of the individual movers, some of the bigger stock stories of the day. First up, look no further than Fisker. Shares surging today. Look at that, up just about 30%. This comes after releasing its Q4 results. The company reaffirming plans to begin deliveries of its highly anticipated Ocean SUV this spring. The company isn't taking its foot off the pedal, adding that it plans to produce more than 40,000 vehicles this year. Lots of questions about whether or not they're going to be able to do that. But Jared, taking a look at the reaction here, the street obviously very encouraged by the fact that the company did reiterate its plans to begin deliveries this spring. Also a bullish outlook here, saying that they think demand is going to rise once the deliveries do begin and brand awareness grows here. So rising despite the Q4 results falling just a bit short, the company posting a loss of $170 million. We'll see what demand looks like for this Ocean SUV once we get the first few hitting the road here in just a couple of months, it sounds like.
Yeah, I mean, this has been kind of long awaited as well. Most of these EV cars, these concept cars, well, when they start out in the concept stage, look nice and modern. And then when you finally roll them out, at least I'm scratching my head. We've been actually seeing that for a couple of years now. But here's what I'm watching on the Wi-Fi Interactive is our EV heat map. And if I sort by whether this is just what happened today. So Fisker up 30%. But you take a look at what's happened over the last year. Some of these losses are quite palpable. And then when you take a look at where FSR is on that list. It's down 38%, so kind of in the middle of the pack, not down nearly as much as some of the others, but a lot of the charts look like this. A lot of room to go there.
Yeah, certainly. It's going to be a big week for the EV space in general. We have Rivian reporting tomorrow. Mizuho reiterated its buy rating ahead of those results. Its view on execution, they think that it's going very well. And then we also have Tesla's Investor Day on Wednesday. So certainly a lot of focus here on the EV space. What demand looks like there clearly will be key here moving forward as we try to figure out what Main Street adoption looks like and how long it looks like that runway is until we see more and more EVs on the road.
Yes, and now we got to talk about what's moving stuff on the tracks. Shares of Union Pacific also spiking higher today following news of a change in the company's C-suite. Union Pacific announcing on Sunday that CEO Lance Fritz going to be stepping down by the end of the year, and that is thanks to pressure from hedge fund Sorbonne Capital Partners. Now, this is just the latest example of activist investors pushing for change at some major companies, with Starboard Value, Elliott Management, third point among the activist investors taking a stake in software giants in the recent months. And additionally, I would say ValueAct CEO Mason Morfitt has been appointed to the software giants board, which is going to take effect on March 1st, the same day Salesforce reports its fourth quarter earnings. So lots shaking out in the M&A space, Shauna.
Yeah, certainly. We have seen a rise in shareholder activism and investor activism, I should say. Certainly something that we have been talking about time and time again. When you take a look at some of these numbers, Lazard was out with recent data showing that the number of new overall campaigns last year hit 235. That's a rise of about 36% comparing it to the number that we saw back in 2021. In terms of Union Pacific, the reaction that we saw in the stock today, shares there jumping on this, just in terms of the fact that it looks like we will get a new CEO there, with Lance Fritz saying that he will be stepping down. Bank of America upgraded the railroad operator to a buy. They had a neutral rating. They cited that leadership change as a reason that they are more bullish on the stock. But certainly we have seen more activism here in some of these larger blue chip industry names. Those have been targeted. You mentioned the activity that we're seeing in Salesforce. You can really see it across the board. Technology, the most frequently targeted sector in 2022, represented about a fifth, 21% of the activist targets there. So as we saw the large decline in many of those tech stocks, certainly an opportunistic time for some of those activist investors to get involved.
Yes, indeed. And it looks like we got some stocks closing today higher, investors waiting for what is next here. But as we are considering what's next from the Fed, Shauna.
Yeah, the latest housing data, Jared, was one of the main things that the street was looking at today. And when you take into account the activity that we've seen, this is just the latest evidence here that the economy is resilient. Take a look at people buying homes once again, with jumping about 8.1% month over month. You're looking at pending home sales. So month over month increase, though it is off 24% on a year over year basis. So here to discuss what this means for the market, what this means for Fed policy going forward, we want to bring in Brian Say. He's the Capital Stewards founding partner. Brian, great to have you here. So, of course, the real estate market maybe not be the best thing to point to here, but pending home sales was stronger than expected last month. How are you looking at this just from an equity perspective and the activity that maybe we'll see in the markets here going forward?
Yeah, so on pending home sales, we sort of suggested back in December, it seems like the market is bottoming out. The housing market, the underlying fundamentals are pretty strong. There's a lot of folks that are starting to form families and they need housing. It was underbuilt for a really long time in the United States. And so the sort of pessimists got really pessimistic back in November and December when mortgage rates were kind of at all-time highs. But now those have come down a little bit. And so the housing market in particular is kind of bottoming out. And it's going to go maybe sideways from here, but we're done, and we're not going to see some sort of crazy correction like we saw back in 2007 and 2008. Overall, when we think about the economy, our view is that it's slowing down, which is exactly what the Fed is trying to engineer. We're not in a recession, but the economy overall is slowing down from really high levels coming out of the pandemic.
And Ryan, we're talking about various inflation measures here. So-called supercore, that excludes the housing sector when you're talking about services inflation. That ticked up, I believe, to 4.8% with the latest PCE data that we got last Friday. Depends on how you measure it, but certainly not dropping at a quick rate here. What do you think that says, given that that is the preferred, at least one of the biggest measures that the Fed is looking at right now?
Yeah, the Fed does follow the PCE measure of inflation. And again, I think it's really important that we look at any economic data and we back up and we look at trends over longer periods of time. It's really, really difficult to guess which way economics is going to go this month or next month. You've got to back up and look at longer term trends. And when we look at longer term trends, we see PCE going lower. It peaked at almost 7% last year. Now it's down to 5.3%. And it's not going higher; it's moving lower. The labor market, certainly remains really tight, and I expect that that's going to continue to be the case. There's no magic that's going to happen as we get into the second part of this year that's going to produce more workers that are going to come back into the market. But even if the labor market remains where it is now, even if it remains really robust, if we see housing, food, energy, consumer goods prices continue to decline, then we can get to the high 3% range on PCE by the end of the year. So we can get to a more reasonable level of inflation. And that can be a pretty good environment for the economy. If you just think about the 1990s, we had inflation levels 3 to 4% on a regular basis, and we were just fine.
And Brian, when we think about the Fed's terminal rate, that is, they're raising short-term rates and eventually they're going to get to a level at which they stop. And that's kind of what the market has been trying to figure out. It looks like the street expectations and the Fed's expectations are somewhat in alignment right now. But we're going to get a brand new summary of economic projections from the Fed at their next meeting in March. And there's a lot of chatter that that's going to move up, that their expectations for what they're going to do for their terminal rate are going to move up even further than they are now. So just wondering how the market you expect the market to digest what's going to happen at this next Fed meeting.
Yeah, I think the Fed has been really clear since the beginning that inflation is high. It's a problem. They're going to continue to raise rates, and that it's going to take a long time for the market to correct and for inflation to fall. The market has struggled to believe that narrative coming out of the Fed. And I think what we've seen over the last couple of weeks is the market coming around to the fact that it is going to take a while for inflation to come down, because even though some of those metrics that we talked about a minute ago, and housing and food and energy and some of those things are coming down after some shocks last year, that core labor market still is really, really tight. So as we come into the next Fed meeting, I think the market has gotten that message finally. I think we see longer term interest rates starting to go up and sort of price in higher rates for longer. And so I don't expect there to be a significant market reaction just because the Fed sort of says what they've been saying for a long time, which is that they're going to take rates a little bit higher from today's levels probably and leave them there for a period of time. And when they release the summary of economic projections, I would expect those to show similar things as well. So no huge market reaction coming based on that. But that probably would have been a completely different conversation 6 or 8 weeks ago when the market still sort of was fighting the Fed, as they say.
Yeah, I would agree there. And just thinking about some of the investments that might do well under what you're projecting, what are you looking at here? What kind of opportunities for investors?
Yeah, so I think it's really important to look back at historical data when we think about what does well in periods of market turbulence. I think when we look going forward, we say, hey, rates are higher. Maybe we're going to have a recession. Maybe we're not going to have a recession. Everybody wants to go into those more traditionally conservative sectors, into utilities, into consumer staples, things like that. And the reality is over the last month, as we've had some market volatility, and last week when we had market volatility, the S&P 500 growth index outperformed the value index here short term. And that was also true during the financial crisis and during the COVID recession. And by the way, there's a big difference between quality growth and sort of like venture companies with no profits, no cash flow, where all of that economic benefit is further out. But when we think about companies that are profitable today, that are growing their business, regardless of the economic environment, that's really the place that we want to be as we go into sort of a slower growth period, regardless of whether we end up having a technical recession or not.
All right, Brian Zay, we've got to leave it there. The Capital Stewards founding partner. Thanks so much. Let's get to some breaking news. Zoom is out with its most recent earnings results, and you can see the stock up just about 4%. A lot of that has to do with the guidance that we're getting here from the company. Full year profit forecast coming in better than expected. Zoom seeing adjusted EPS for the full year of $4.11 to $4.18, blowing past the street's expectations of $3.53. Revenue guidance a bit light here, but focusing on the fourth quarter results, revenue up 4% on a year-over-year basis to $1.1 $1.12 billion. You can see it there on your screen. Adjusted EPS coming in at $1.22, blowing out of the street's expectations out of the water of just about 80 cents. Taking a look at enterprise revenue, that's up 18% year over year to $636.1 million there. So some solid results in the most recent quarter, but the guidance there, full year profit guidance, Jared, one of the reasons that we're seeing this stock pop about 4.5% after hours. And remember Zoom, I don't think we have to remind many of our viewers out there, but this was a pandemic darling. We saw this stock shoot higher during the pandemic as more and more people were working from home. They were using Zoom services. So now Zoom, of course, has been under a little bit of pressure here to find those new offerings, to get those new offerings to offset some of the sales slowdown that we are seeing in its video business here, and it's really why it was so successful, the backbone of its business. So new offerings doesn't seem to be offsetting all of that slowdown here, but certainly the street encouraged by these results.
Yeah, I think in the context, and yes, I remember when they were a pandemic darling, they were Yahoo Finance's Company of the Year in 2020. But you take a look at some of their larger companies and the revenue they were expecting to get from them. And here's where the key metrics I'm looking at. Number of enterprise customers, 213,000. Street was expecting 216,588. So that number coming in a little bit under expectations. And then customers contributing more than $100,000 in trailing 12 months revenue, 3,471. That's 3,471. Street was expecting more, 3,601. So still need to get their larger customer base up to snuff there, at least in terms of what the street is thinking. All right, coming up, you just heard Zoom's numbers. Now Occidental Petroleum is on tap. We're going to bring you their latest quarterly report after the break.
Taking a look at shares of Zoom, they're now nearly 6% in extended trading. The company reporting revenue of $1.12 billion. That's up 4% year over year. Adjusted EPS coming in better than expected, $1.22. The estimate in the street was for 80 cents. In terms of its full year forecast, adjusted EPS full year forecast also coming in stronger than what the street was anticipating. Adjusted EPS, they see it as $4.11 to $4.18. The estimate was for $3.53. Let's talk about all this and what else we could expect here from Zoom. We have Peter Levine. He's an analyst at Evercore ISI. Peter, it's great to see you here. So shares popping on the heels of this report. What's your initial take?
Nailed it on the head. I think profitability came in better than expected. EPS, people want to see higher free cash flow margins, which they got, as well as operating leverage in the model. I think Q1 guidance and fiscal 24 guidance, I think was a little disappointing, came in well below the street. But again, I think they offset that with profitability and cost conscious, I think, initiatives.
And Peter, what did you think of some of the numbers here regarding their enterprise customers? That was a metric that didn't quite live up to Wall Street expectations. 213,000 for the fourth quarter versus expectation of 216,500, and then customers contributing more than $100,000 in trailing 12-month revenues. That metric also a little bit light there.
Yeah, it's been trending downwards for the past couple of quarters. So it was a slight miss. I think the other important metric I think people should look for is the net retention rate of 115. That's been slipping below that 120 range. At 115, again, that just shows you that I think their ability to upsell customers, is not as easy as I think they initially thought going into the year.
And Peter, when you take into account the new offerings, it doesn't seem like, at least as of yet, that it's big enough to offset some of the sales declines that we've been talking about. What do you think the timeline more realistically looks like on this process in terms of getting to that higher yielding growth?
I think it could be a while. I think the next catalyst is contact center. I think the video market, which is their core business, is completely saturated. I think what they're doing, Zoom Phone, I think is probably the next leg of growth. That should hit based on, in the second half, call it 10% of revenues, a $500 million business, which they've scaled in 2 years, which is really impressive. But that business has become commoditized. So I think the focus is really on contact center. And that's probably, 2-3 years. That's an initiative that's longer term. So I don't really see the benefit from contact center coming in. And again, in a tighter market, companies are cutting costs. If you're seeing layoffs, that means you don't need that additional Zoom license. On top of that, where we are in the pandemic, anniversarying almost 3 years, if you haven't already provisioned your employees either on Zoom or consolidated or standardized on Teams, it's unlikely to happen. So I think the upsell, is going to be a little tougher for them, especially in this market.
And Peter, just thinking about how some of the big tech giants are completely pivoting their business models to AI, just wondering, because we see it's a natural fit for a lot of software companies, and there's always the Me Too bunch that kind of jump in at the last minute where it doesn't necessarily make sense. But is there an AI place to be made, that case to be made for Zoom?
Oh, absolutely. For them, I believe so. I think anyone in the communications space definitely benefits, the Microsofts, the Zooms, the Five9s, with Zoom, on the contact center, automating agents, live chat, incorporating AI into those workflows absolutely makes sense. And again, even on the video side, augmenting the transcripts for videos, what they can do in terms of, on the phone side with routing. Yeah. So there's definitely a real use case for AI with Zoom in terms of a lot of automation as they move into other markets.
So Peter, with automation taken into account, lots of focus on the cost-cutting efforts at Zoom. We know that they did announce plans to lay off 15% of their staff recently. Do you think more cost-cutting measures are going to be necessary here, looking out to the rest of the year and maybe possibly into 2024?
It's a possibility. We'll find out on the call where those cuts are coming from, if it's on sales and marketing, if it's on R&D. I think, for Zoom, the initiative is R&D and building out the product portfolio. So the question becomes, if they cut costs, they have $5 billion on the balance sheet, they don't have debt, they have market cap. So do they kind of pivot and maybe do an acquisition to kind of accelerate their go-to-market and then, push products to market? That's a question we'll have to hear on the call. But 15%, it's a tough decision, or a tough decision for them to make. But I think it's a tough call from an analyst point of view in terms of like what their priorities are. But again, I'm hopeful that they'll give us some more color on the call.
Peter, what do you think about a possible acquisition, just in terms of the scenario? What would make sense here for Zoom? And in terms of that acquisition, who should they be targeting, or what line of business do you think is really going to give them the boost here going forward?
I think it's maybe again, we saw their failed acquisition of Tempo 5.9 almost 2 years ago. So I think it would be interesting if they do something in the contact center side. I mean, that's a very difficult and complicated asset to build organically, which is what they're doing. So, I mean, if I was, I would like to see them do more. I think on the contact center side, perhaps they can do something on the phone side. But again, if you're thinking about like the next leg of growth, which is still contact center, again, that asset itself in that market, there's still, they have pricing power, right? Unlike voice and video, where that's become a little bit more commoditized, the contact center, again, still demands a premium. So yeah, I think their focus should probably pivot more towards, I think, an acquisition on the contact center side. And again, I'm not recommending it or suggesting anything, but I think if I was them thinking about cost, and the quickest way for them to go to market would be to acquire an asset on the contact center side.
All right, got to leave it there, but appreciate your insights here. Peter Levine of Evercore ISI. Switching gears, Occidental Petroleum out with earnings right now, or Ines Ferre has the numbers. Ines.
Yeah, Jared, it's a miss on the top and the bottom line, with net revenue coming in at $8.22 billion. The street was expecting $8.47 billion. Adjusted earnings per share coming in at $1.61. The street was expecting $1.80. It's all, though, about returning cash to shareholders, because the company's announced a $3 billion share repurchase program and 38% increase in common dividend, with Occidental's quarterly dividend now at 18 cents a share. Previously, it was at 13 cents. Also, Occidental Petroleum saying that it completed a $3 billion share repurchase program in the fourth quarter. And also, it has repaid $1.1 billion of debt, with total year debt repayments of over $10.5 billion, representing 37% of the total outstanding principal. And Vicky Hollub, CEO of the company, talking about this $3 billion share repurchase program, also talking about delivering substantial balance sheet improvements. And she goes on to say, our teams are well positioned to maintain this operational success as we continue to focus on delivering value for our shareholders in 2023. Now, the stock is having a little bit of a muted reaction. It's down slightly in after hours. But look, year to date, the stock is down 6%. But in 2022, last year, this stock was up 117%, guys.
Yeah, maybe we can forgive it for the lack of volatility in after-hours trading. Thank you for that, Ines Ferre. Coming up, we're going to take a deeper dive into Occidental's earnings. Stay with us.
And new reports on the state of the housing market. Here is what you need to know. Tesla's annual Investor Day is on Wednesday. Expect news on new models, battery technology, and the company's latest expansion plans. Elon Musk previewed the event on Twitter in his typically not so understated way, saying the event will be a big deal, not just for Tesla investors, but for all life on Earth. Meanwhile, on the planet Pandora, blockbuster films like Avatar: The Way of Water made mega bucks for movie theaters in the past few months. We'll see how it helped the world's biggest movie chain, AMC, when it reports earnings Tuesday. Also, watch for earnings from Yahoo Finance's 2022 Company of the Year, Costco, as well as numbers from Target and Zoom. And industry insiders and the Fed will be on the lookout for the latest durable goods orders and pending home sales. That's all ahead in the coming week.
Welcome back. Shares of Occidental Petroleum, as you can see on your screen, they're trading fractionally lower. This comes after a miss on both its top and bottom lines in the company's fourth quarter earnings release. Now, the company, while the company announces a $3 billion buyback share repurchase program, we have, for more results about the company, Stuart Glickman, CFRA Energy Equity Analyst and Deputy Research Director. Thank you for joining us here, Stuart. Great to see you. What's your takeaway from these Oxy earnings? Looks like a little bit light on some of the fourth quarter numbers that we were looking at, but what about the guidance?
Hi, Jared. Right. So thanks for having me. So you're right. Fourth quarter numbers a little bit lighter than we had expected, lighter than consensus. I think the big picture takeaway is that the operating cash flows that this company is generating is still pretty impressive. And that is leading to spending on things like the buyback program. The CapEx for next year is probably going to be higher than in 2023 than it was in 2022. And I think we're going to learn on the earnings call tomorrow, what some of the key priority areas are going to be for 2023, which I think was going to include certainly boost in production, probably somewhere low single digits would be my best guess. And then also probably some spending on infrastructure. But I think the big issue for tomorrow is going to be, how much of a CapEx increase is likely to be coming, how much of that is really organic activity versus cost inflation. And we've seen from some of Oxy's peers that have reported recently, when you put out a number with a fairly significant CapEx increase, the stocks have had their hands slapped by the market. So I think that's going to be interesting to see.
Yeah, Stuart, that is a huge focus in this report, or really what we will likely learn on the earnings call tomorrow morning. From an analyst perspective, obviously you've covered the stock now for quite some time. What are you expecting to see on that front, and how big of a headwind do you potentially see that being for Occidental Petroleum, at least in the near term?
Well, it's a good question. So to put it in context, I think the average E&P next year is probably going to be spent somewhere in the neighborhood of 15% more 2023 on 2022. So the ones that have stood out, I would say, are EOG and Devon so far this year. EOG, for example, just last Friday talked about a CapEx increase that was around 20% to 25% higher in 2023. And their stock took a hit following that news. I think in Oxy's case, let's put this in a little bit of context. They had a tremendous year in 2022. The stock hasn't done all that great so far in 2023, but when you're up over 100% in 1 year, you might be forgiven a little bit for some settling, I guess, in the stock. And I still think that the outlook is fairly positive for Oxy. I think that the amount of free cash flow that they're probably going to generate is still going to be pretty strong, unless the CapEx budget with cost inflation that's baked in is so out of control that really sort of pulls in the sails on free cash flow. But I don't expect that that's going to happen. Oxy is one of the major producers in the Permian Basin. That's really kind of the nerve center for U.S. oil production in general. They have their own midstream assets, which is nice to have when midstream becomes constrained. They're starting efforts on carbon capture sequestration, which probably has legs to it just because of the ESG crowd. So I think there's a lot of things that point
Stuart,
in Oxy's favor.
We just had Warren Buffett, Berkshire Hathaway's annual shareholder letter released over the weekend here. And I'm just wondering, this is a huge Buffett play, got back into energy in a big way a few years ago with Occidental Petroleum. That was right around the time that they were taking over Anadarko Petroleum, which was a highly criticized deal because it was deemed expensive at the time. Buffett loaned some money, or Berkshire loaned them some money. Just wondering how we stand here with Occidental and Berkshire's interest. Do you think there's ever going to be a full takeover, or just what do you see the dynamics here?
So it's a really interesting question, Jared. At the time of that deal, where Warren Buffett helped enable Occidental to purchase Anadarko, I really hated the deal. I thought that it was not shareholder friendly. I thought it was expensive. And credit to Vicky Holub, but the last couple of years, particularly 2022, they have really been able to make this kind of a transformative move. They've paid down a lot of the incremental debt that they took on to make this purchase. They're materially bigger in size in the U.S. If oil prices are able to sustain themselves at relatively high levels, and by that I mean, let's say call it $70 a barrel or higher, which I think there's a very good chance of that happening because the industry's been so capital starved for so long. I think all of those are pluses. Now, Warren Buffett already has significant exposure to Oxy by virtue of the preferred shares that he owns, which are going to throw off 8% dividends every year, by virtue of the warrants that he will be able to exercise once the preferreds are retired, which will come, I think, at the latest in 10 years' time. So he already has exposure to the fortunes of Oxy. Whether he actually chooses to go ahead and purchase more of it, I think certainly remains to be seen. But he has a pretty significant stake at this point already. And I think that he's thinking longer term as well, and that the prospects for Oxy as one of the big workhorses in U.S. oil, in U.S. shale, I think makes a lot of sense.
All right, we can see shares off just about 0.8% in extended trading. Stuart Glickman, great to have you. Thanks so much.
Thank you.
Well, coming up, Elon Musk will reveal his latest master plan for Tesla's future on Wednesday. Find out what that could be next.
Tesla will hold its investor day on Wednesday in its Gigafactory in Austin, Texas. Yahoo Finance's Prab Subramanian has the details. Praz, lay it out for us.
Yeah, Jared, 4 o'clock Eastern on Wednesday, so during the show, of course. But yeah, we're watching a few things here that I wrote about here. A couple things. First of all, long-term expansion plans. Tesla talking about how they want to make 20 million cars by 2030. How are you going to do that? You're going to need about 12 factories, what Elon Musk is saying. So maybe we'll hear something on Tesla Mexico, Tesla Canada, Tesla Indonesia. We'll see. That could be coming up. Also, the Gen 3 platform, that's the cheaper car potentially that would cost $25,000 to $30,000. Maybe it could be a robo-taxi that Musk has mentioned before in the past. When is that coming? When can they make that? How efficiently and cheaply can they make that car? That's another question people will be asking. And finally, that master plan part 3 that Musk has also teased. We're going to include part of that expansion plan, the Gen 3 car, but also clean energy. What are the solar plans for Tesla? Are they going to revamp the offering? And they paused some of those solar installations. Are they going to go back and do those in commercial and residential applications, and also battery storage, power packs, the power wall for the home? We're going to hear more about that, more installations, maybe a new product offering, better tech, and also minerals. How are they going to get lithium and cobalt, things like that for a lot of these batteries?
Sounds like a lot of news that we will be gathering from you in a couple days here. But also, Porsche has been in the news today about an expansion of its classic business. And Praz, you spoke to Kjell Gruner, the president and CEO of Porsche Cars North America. What did he have to say about this?
Yeah, Kjell Gruner, the Porsche US CEO. So they're investing in the classics business, but also before we get into that, I want to talk about the business right now. They had a crazy, great record 2022, right? So the question is that performance bleeding into 2023? Here's what Kjell had to say about that.
It was a record quarter. It was a record December. That shows you that we started this year with a lot of momentum. So the brand is very strong. The product pipeline is very fresh, very attractive. Our new cars, the Carrera T, the Dakar, has a great reception end of last year. At the LA Auto Show, the world premiere, a lot of momentum. And this year we will, for instance, get the new Cayenne, which will be super important for our business. So the brand has a lot of momentum. There's a lot of love for the brand. Both from our sides, we love what we do. Our dealer partners do that, and the customers as well.
So Porsche would have sold more cars like the Taycan EV if not for supply constraints, Gruner said.
All right. Well, Porsche is opening a new expanded Porsche Classic facility at its Atlanta headquarters. And can you tell us something about that?
Yeah. So, Porsche had a great year last year, but they know where their bread's buttered, right? It's the classic car business. They're enthusiast fans. They love these air-cooled Porsches. So they're investing in that business there to kind of assuage those fans. But, in a $50 million new facility there to refurbish and renovate these classic cars. But in order to directly compete with this, to interact with these customers in a more one-on-one way. So here's what he had to say about that.
It comes from the core of the brand. It is something that we love. And then obviously it's always great when you do things that are also economically feasible, because that makes them sustainable. That means you can do them over time, and that also means you can invest in that. So you can see that with our extension of our campus here in Atlanta. So there we invest a lot into our classic business.
So he says it's sustainable, but the U.S. is Porsche's largest classic market, over 300,000 cars, and they sell 80,000 parts for those cars. So it's a business too.
It is, but when we talk about some of these older vehicles too, I've had uncles tinkering in the driveway with these things. We're talking about a new era. There's just a lot more, infrastructure that people need to gear up for in the EV age. So Praz Subramanian, thank you for that. Coming up, Jeff Bezos' reported pursuit of the Washington Commanders may already be sacked. See why when we come back.
Warren Buffett's annual shareholder letter is out. Here are 3 top takeaways from the Yahoo Finance team. First up, a call to action to all humans: start saving money. Buffett says this: "It is those dedicated savers that are forefront in my mind as I write this letter." He adds, "Charlie and I are not stock pickers, we are business pickers, telling people to save money." And maybe they're listening. The U.S. savings rate is now at a 1-year high at about 4.7%. I think Buffett wants to see it even higher. Takeaway number 2, investing school is in no session. Again, no surprise here in the Warren Buffett annual shareholder letter. Buffett noting this, saying, quote, "The lesson for investors: the weeds wither away in significance as the flowers bloom. Over time, it takes just a few winners to work wonders." And yes, it helps to start early and live into your 90s as well. Warren Buffett, 92 years old. His longtime partner, Charlie Munger, 99 years old. Warren Buffett saying, if you want to be a successful investor, invest for the long term. No surprise, that's typical Warren Buffett being Warren Buffett. Takeaway number 3 here, a message or messages to all politicians here. Warren Buffett taking some jabs at folks in DC, noting this: Berkshire also offers some modest protection from runaway inflation, but this attribute is far from perfect. Huge and entrenched fiscal deficits have consequences. Interesting take there from Buffett. Buffett also says, really tries to, I think, champion stock repurchases, saying repurchases, those that tell people that repurchases are harmful to shareholders or to the country are particularly beneficial to CEOs. You're listening to either an economic illiterate or a silver-tongued demagogue. So Warren Buffett taking some swings at politicians. What we did not hear in this letter: no succession plan. Warren Buffett and Charlie Munger will be at that May 5th to May 6th annual shareholder meeting in Omaha. Brian Sozzi out.
All right, speculation around a potential bid for the Washington Commanders by Jeff Bezos continues to swirl. Our own Josh Schaefer is here with the latest. Josh, where does this stand? Because day in and day out, we're hearing that he's interested, he's not interested. Dan Snyder wants him to bid, doesn't want him to bid. What do we have?
So the latest from The Athletic, they're reporting that Bezos has, quote, been barred from providing even a bid to buy the Commanders. So multiple outlets reporting that Bezos has not actually bid yet. That's the key here. He hasn't put in a bid yet. But The Athletic reporting that basically the beef between Dan Snyder and Jeff Bezos is what the division is here. And the beef that we're referring to would be that Bezos owns the Washington Post. And when you think about all the drama surrounding the Commanders and all the wrongdoings that Dan Snyder has potentially done there, the lead outlet reporting on that often is the Washington Post. So it would certainly add up if Dan Snyder is maybe not the biggest fan of Jeff Bezos and his publications reporting. Now, the other key thing to note here is it's not like the Commanders have shareholders and investors that Dan Snyder needs to keep up with here, right? If Bezos does make a great bid, like some of the public companies we cover, like say if someone wants to buy Twitter for a big price. But that won't happen here. So Snyder doesn't have to sell to Bezos if he doesn't want to. So potentially Bezos could just be cut out, Jared.
So let me ask you a bigger picture question. Why does Bezos want to do this in the first place? You talked about the Washington nexus, but why would Bezos potentially want to get into sports?
So Jared, obviously, there's an overarching, people think it's cool to own an NFL team, right? And that's part of the billionaires club. But maybe for someone like yourself, we've talked sports before, I wouldn't incline you to maybe go buy an NFL team, right? But I think you might if you take a look at some of these stats I brought today, all right? So if we look at the revenue and sort of the path to profitability for an NFL team, we can use the Green Bay Packers from last year. Their total expenses were $501 million. On the left is the national revenue. That came in at $347 million, about 70% of the way to profitability. That's before the Packers played a snap. That's the national revenue that gets divided between all teams before the season even starts, before they sell a beer at the stadium, before they sell a ticket. You're 70% of the way there. So not bad, right? Then let's take a look at the viewership and how many people view NFL games. That chart right there, that is the most watched television programs in 2022. 82%, 82 of the 100 most watched programs in 2022 were NFL broadcasts. That's more than any other sport, obviously, as you can see there. That's more than any other program.
That's us, 6% non-sport.
That's us. That's actually Yahoo Finance in the yellow there. Okay. And then our final stat for you, Jared, here is the franchise value of the Washington Commanders. That's pretty much a hockey stick. And when you take a look at that, the other key is you don't see the value ticking down a lot, right? When we talk about stock growth and potential long-term investments, sure, you can talk about big returns, but maybe down years. Right now in the sports market, the teams don't go down year over year. And that's why some billionaires view it as a safe place to put your money.
Is there a safe place for me to put my money in an NFL team right now?
Put it in the Commander.
You convinced me.
How about the three of us? The three of us pull it together and we'll put in our own
We
bet.
wish one day, if we're all lucky enough, certainly buying a sports team, it makes a heck of a lot of sense. All right, Josh Schaefer, thanks so much. Well, coming up next, we will revisit some of the biggest stories of the day, also some of the top movers here after hours. Stick with us. All right, let's take a look at what is trending after hours. A couple of names for you. Occidental, Hims & Hers, Workday, and Meta. Kicking off with Occidental, we're looking at losses of just about 1.5% in extended trading. Now this oil company, oil player here, issuing a new $3 billion share buyback, but the company did miss on the top and bottom lines in its most recent report. Sales totaling $8.2 billion. You're seeing the losses here after hours over the last 3 months. You're looking at losses of about 16%, but let's take a look at that 1 year chart because the stock's still up about 52% over the last year. 2022 was a very solid year there for Occidental. Let's take a look at Hims & Hers because shares rallying off the highs here in extended trading was up just about 11% not too long ago. We're now looking at gains of about 6%. The company's fourth quarter results, also subscriber data guidance, all fueling the action here after hours. They reported a narrower than expected loss. They beat on revenue. Subscribers topping 1 million. First quarter and full year revenue forecast was also better than what the street was looking at. Looking over the last 3 months, we're seeing gains of nearly 60%. Let's take a look at Workday, the software player there, off just about 3% in extended trading. The company beating on both the top and bottom lines. You have revenue growth of just about 20% year over year. The company, though, appointing a new co-president, Sayan Chakraborty, will be the new co-president there at Workday. So some executive changes, also a new person appointed to the board of directors. Some guidance questions might be one of the reasons why the stock is under pressure. Of course, a lot of the focus is going to turn to the earnings call getting underway here. Over the last 3 months, we're looking at gains of just about 24% over the past year. The stock, though, in the red, off about 18%. Let's round it out with Meta. This stock on the move here in after hours trading, up just about 0.1%. Some news just before the closing bell. The company is building a, quote, top-level product group that's focused on AI. AI is certainly the buzzword in tech, and it seems like all the tech giants are really expanding their presence in this space. Now, CEO Mark Zuckerberg announcing this in an Instagram update. It's going to comprise of people who are working across a number of their products. He's exploring experiences with tech, with images, with video. So Meta placing more of an emphasis on AI. Over the last 3 months, you're looking at gains of just about 52%, Jared.
Well, it is closing time at Yahoo Finance, and here's everything you need to know to end your day. We got a glimpse into business spending with quarterly reports from Zoom and Workday. Zoom's Q4 earnings beating on the top and bottom lines. The company posted revenue of $1.1 billion, up 4% year over year, and Zoom beat Wall Street estimates on adjusted EPS as well. That's up $1.22 per share versus the 80 cents that were expected. Meanwhile, Workday trading lower after hours despite reporting fourth quarter results that beat estimates. Now, the software company reporting $1.65 billion in revenue and adjusted earnings of 99 cents per share.
All right, now let's turn to January pending home sales data, which surged 8.1% from December, the largest jump that we have seen since June 2020. You get an idea of how far the market is, though, from the highs of last year when you look at that year-over-year number, which is down 24.1%. National Association of Realtors chief economist Lawrence Yun saying that he thinks, quote, an annual gain in home sales won't occur until 2024.
And finally, Snap is the latest tech company to throw its hat in the AI ring. The social media company announcing it's launching a chatbot named My AI that will use the latest version of OpenAI's ChatGPT technology. Snap is describing it as a, quote, experimental feature for Snapchat Plus subscribers that can be used for things like suggesting recipes or help picking out a birthday gift. We'll see how that goes. However, Snap is warning that, like many other AI services, the bot can be tricked into saying just about anything.
All right, well, that'll do it for us today on Yahoo Finance Live. Thanks so much for tuning in. We'll see you right back here again tomorrow afternoon at 3 p.m. Eastern Time for all your coverage leading up to and after the closing bell. Have a great night.